Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast. Over the past year, I have had the privilege of talking with some of the most influential and thought-provoking leaders in the wealth and investment management space. These individuals are bringing fantastic innovation, amazing thought leadership, some amazing solutions, and thought-provoking to the market that make a real difference in the daily activities of financial advisors, which in turn helps them create better outcomes for their clients. Each guest has shared amazing insight and stories about the industry. With that, I've compiled some of the best moments of the Adjusted for Risk podcast over the past year. And I will tell you, it was no easy task to narrow the list of amazing moments to a select few, really in order to fit them into one episode. So I'd like to give a big thank you to all the amazing guests I have had on the podcast and to all of the listeners who choose to listen to the Adjusted for Risk podcast over the hundreds of other investment podcasts out there. Thank you so much. And I hope you enjoy just some of the best clips of the past year. Without further ado, here are the best clips from Zephyr's Adjusted for Risk podcast over the past year.
Thank you very much, Ryan, for having me on. Pretty excited about it. And you're exactly right. Bonds are now exciting, with yields back to the levels that we haven't seen since 2009. Bonds are exciting.
Adjusted for risk. I want to adjust your retirement savings for risk, and the tax risk may be the biggest single risk in your portfolio.
It's the first new asset class in 170 years. The last time we had a new asset class was the discovery of oil in the 1850s. So this is new and different, as oil was, and it's as transformational as the oil industry has been. So it's not going away. 450 million people around the world own Bitcoin, including 52 million Americans, including among those Americans, a lot of your clients. So if you think your clients don't own Bitcoin or they're not engaging in crypto, I'll tell you something, your clients are buying Bitcoin the same way your teenagers are drinking beer. They just don't want you to know. Because you haven't raised the conversation, you may have said something dismissive or negative, and they're afraid to mention it to you.
So I think there's a lot of reasons to personalize the portfolio, but from the advisor's perspective, it's create deeper engagements with the client, keep the assets stickier to the advisors and disciplined in the market. So the long run return potential can be achieved more likely, right? It's just, when you have that deeper engagement with the client, they're more likely to probably stay in that portfolio and sit it out with you than they are if it's just kind of very transactional in nature.
Do you think investors put too much emphasis on Fed action and monetary policy and what they say, the dot plot? Do you think they put too much of an emphasis when making investment decisions on that?
Yes, I think they do. I think they do because it's proven to be challenging to predict with any level of foresight. And in my view, to implement a portfolio strategy based on that view, to actually generate and to have the assets move in the way that you expect to generate alpha for your clients. There's a lot of codependent sort of variables there that all need to move in the right way. So I just think it's a challenging thing to do. We haven't seen anyone that can do it successfully. We haven't seen the market be able to price it in. It dominates the news cycle, which would probably be a contrary indicator as how useful it is. And it's contrary to what we think should be durable, strategic investment strategies designed to produce strong returns, or at least market-beating returns over longer time periods, right?
How to deal with FOMO? Is it more emotional intelligence? Is it more robustness? Is it being dispassionate? When Howard Marks, who's one of Penn's, sort of famous alumni, also Chicago's famous alumni, comes to campus, someone inevitably asks him or other people like Warren Buffett or others, what's the most important characteristic that leads to good investment outcomes. And almost every one of the speakers that we've ever heard answer that question say something like it's the ability to control yourself, or the ability to be dispassionate, or the ability to have control over whatever it is. FOMO.
I think people should stop contributing to IRAs and 401ks because it's full of termites. The taxes, all you're doing is giving more money, building up more of a savings account for Uncle Sam. Now, people are shocked when I say that. They say, oh, you're Mr. IRA all these years, and now you say don't put money in these things anymore. Right. Because I want you to have more later. You got to think long-term, big picture. So that's really my focus right now, especially how complicated it's got to just take your own money out of your IRA. It's bizarre.
And then last but not least, and this is something me and you had talked about prior to the call, 2024, the political uncertainty. Half the world's population will be voting in either federal or local elections. Obviously, that's going to, cause a little volatility.
Mm-hmm.
But for me, I'm a fixed income guy. I'm a multi-sector guy. Volatility is opportunity.
Mm-hmm.
When we see some type of uncertainty and things cheapen up, we're a dip buyer. So we'll be allocating if we see some type of, market volatility. So it's not necessarily a bad thing.
Yeah, I agree. Across the board, multi-sector volatility, if you use it correctly, it can be a big advantage, right?
Absolutely.
The asset allocation rules and asset allocation relationships, theories, and strategies need to be looked at all the time. It's complicated by a series of things. The distribution is not normal. It's not a huge issue in some ways, except that we know it has to do with time varying volatility. Almost certainly expected returns are time varying. Plus, there are all kinds of questions about behavior. The other thing is that even if you are in a stationary world, when vol goes up, you can expect correlations to go up. Just think about the formula for R squared, which is the proportion of variance in a given asset or your portfolio that's explained by a benchmark or the market. That is a systematic measure of risk divided by systematic plus idiosyncratic. That's literally the equation for R squared. That's a percentage. And what happens in a tough time? Well, very often systematic risk goes up. If idiosyncratic risk doesn't go up, then R squareds go up, and R squareds are just the square of the correlation between your return and whatever you're calling systematic. So just when you need the great benefit of perhaps the only free lunch in all of economics, diversification, it becomes more challenging at periods of higher vol.
We often talk, ever since COVID and markets, I kind of think have gone irrational a little bit with meme stocks, and we've got the roaring kitty is roaring again, and meme stocks are making a comeback. Does asset allocation, and we talked about like beta and some of these statistics that are based on modern portfolio theory, does it still matter, do you think?
I think it matters more than ever.
Okay.
At Lido, we could have a debate of how much return does asset allocation drive? You could say 90%, I could say 98, we'll probably settle around 95. It is exceedingly important, and I'd argue as a financial advisor, it is the number one lever you can pull to affect returns and risk.
The other thing that these days about asset allocation and the efficient asset mix idea is getting not just down in, moving from individual investments to asset classes, but now moving from asset classes to risk classes or clustering classes. And what by that, I mean, not just thinking about allocations, but thinking about the style behind it, which obviously you spend a lot of time doing. And then what kind of risks go into that? It's been a tough, we're sitting here in 2023. It's been a tough run in the first quarter for quality, for momentum, and for value. It's an almost diametric opposite at an asset class level to what we saw last year. I think you would still, despite that, I still think you want to be diversified across styles. And that would include quality, that would include momentum. And I think when you're thinking about an efficient asset mix, you want to at least know when you start picking investments that will get you to an efficient point, what tilts, if any, you're taking on those risks. And is that optimal for you? Because of what can happen, for example, like we saw in the first quarter.
Standard deviation, it's always kind of been the go-to risk statistic for for wealth management, and rightfully so. It's easy, people understand it. It's kind of the granddad of risk or volatility statistics. But is it time, you think, for wealth management industry to reconsider how it views and evaluates investment risk?
I do. But when we talk about standard deviation, let's first define what we're talking about. Now, commonly, people use the statistical metric of standard deviation as volatility. Essentially, what that means, the simplest thing is how far something moves, either on the upside or the downside. Now, when we use the term volatility, people think a negative connotation, right?
Yeah.
Oh, it's going to move down. It's going to be, that's not great. However, it also is positive, meaning does it move up? How big does it move up? Now, if you tell me I can take all the positive volatility in the world, I'd be like, great, I want the thing with the most positive volatility possible all day. But that doesn't really tell the standpoint of risk, because as you mentioned, over the past, there've been all these up years. So that's all positive volatility. Yeah. In the simplest term, statistically speaking, please forgive me, there's other metrics that talk about losses, I think, more accurately. People use the term value at risk, or VAR for short. I think that's a little bit better because it's talking about, hey, if I invest this, how much of my investment is at risk of doing something adverse? Or if you get really sophisticated, again, my apologies for causing post-traumatic stress by saying about this, there's another metric called conditional value at risk, or CVAR. I think that's a little bit more eloquent when you're thinking about downside. But then there's even simpler topics like downside capture. When the market gaps down 10 or 20%, how much of that do you capture? I think that's really key for advisors and investors, in a simple way of talking about it, not the other, sort of more complex topics. It's like, hey, if the market's down 10, how much am I down? Okay, great. You have a 60% downside capture. You're capturing, you'll be down 6 when the market's down 10. That's a better way of thinking about it. And the other thing by that, we're sort of taking outside that positive volatility out of the equation. So things like that, I think statistically we should ground into. You can always use beta. Now, beta is a market sensitivity metric. The simplest way to say it, hey, if the S&P 500 is down 10 and you're down 10, you have a beta of 1. So, but that's also downside capture. If we're really driving that home, I think those metrics should be talked about more than they are. And they're also, my personal opinion, a little bit easier for an investor to understand than, hey, here's conditional value risk, here's this, here's that. I think those, if we just reground it in simplicity to as we're talking about, I have $100, the market goes down 25%, I'm going to capture half of that.
How do you feel about 60-40 portfolio? Is it, is it dead? Should we look at it differently? Maybe, it shouldn't be 60-40, but maybe 60-30-10 with alternatives, or what's your thoughts on the 60-40 portfolio?
Yeah, so there are at least 4 reasons to pay attention to it. And I kind of have a love-hate relationship with it. If you hated it over the last 13 years, not including the most recent volatile period, but during that, ongoing decline, secular decline in bond yields, at the same time you saw, unmitigated, what felt like unmitigated multiples expansion in the S&P, unexpected high returns on the S&P, unexpectedly high returns on bonds, stocks and bonds both killing it unexpectedly. That was hard for many advisors to deal with, because they outperformed for a long time. They outperformed their expectations. The 60-40 outperformed its history. The US 60-40 outperformed international 60-40s. It was a real US 60-40 period. But there are 4 reasons so you might say, well, now what about the future? Maybe we better downweight it and think about something like, a 60-30-10 or something. But there are at least 4 reasons to think about it. Number one, if you run a stock bond efficient mix, typically 60-40 is either efficient or pretty close to being efficient. It's definitely on the positively sloped portion of the frontier, even as the frontier has flattened generally since the financial crisis. That's sort of when I identify it. Number one, it's efficient. Number two, it's cheap. It's easy, right? Yep. You can invest in 2 ETFs or even 1 ETF and get it, really, really cheap. Futures contracts, nearly free. The third thing is that it's related to the 4% rule, right? The famous 4% rule, the Bengen rule. that says that all you need to do is, allocate to a 60/40, withdraw 4% of your wealth, and rebalance at a reasonable frequency, and over a 30-year time period. In a real sense, you have a 95% chance of making that retirement period. I think probably that's a 4% rule. I think today probably like orange is the new black. There's really a 2.8% rule, but it's there. So easy to do. You can do it DIY, super cheap. It's efficient, and it's tied to the 4% rule. The problem is it's not risk diversified. And you've seen these arguments for a long time now. A 60/40 is really a 93.7, an 85/15, and 95/5. When you look at the risk, most of the risk, last year maybe is one exception, but most of the risk comes from the equity piece. And so if you look at what it correlates with, especially at bad times, this R-squared effect that you see, where when volatility goes up, things get correlated, make the 60/40 look a lot like just, equities. It's still the case that the fixed income part tends to dampen volatility, and there's some correlation benefit, but it's a pretty vanilla portfolio.
Fantastic.
To add to that, we live in a democratized world. You can access alternatives. You can access inflation assets. A traditional 60/40 does not, in my view, work well in inflation shock time period because of the effect on yields, and because of the effects on growth. And again, that means if you're in a 60/40, you may have challenges, especially if you're, there's mark-to-market issues or you're withdrawing money from your portfolio. I think you have to be very careful about it. I believe there are better ways to invest in many circumstances in the 60/40.
You talked about asset allocation. Is a personalized portfolio, is it just an asset allocation that maximizes a return per unit of risk and that's unique to that client? Or is it more granular than focusing just on the overall asset allocation? Do we get more specific than that?
So it can be both. So personalization can be done within a sleeve in the overall allocation, or it can be done at the allocation level. The programs allow for kind of both of those. So for example, at the sleeve level, I'd say the most obvious manifestation of it is direct indexing, where you go in, and by the way, it's called direct indexing because it started out as, an index that you buy at the same weights as, say, an ETF would buy, except I own the underlying securities. A lot of the reason, and some DI providers will say, oh, the reason you do this is tax loss harvesting. Yeah, that's a big piece of it. But 20% of our DI accounts in-house here are qualified accounts. So it's not entirely a non-qual proposition. Some people just want a low-cost SMA, or they want to be able to customize an SMA for other reasons. So I think you can personalize within a sleeve. You can get very granular with those personalizations because those DI optimizations are, very good at doing that.
You talked about modern portfolio theory, and really that kind of hits home to me. Building diversified portfolios. Recently, a few years ago, I built the efficient frontier with standard equity fixed income asset classes, equity asset classes using Zephyr, and I included Bitcoin. This was a couple years ago, and at the time I was, this was a few years ago, I was very skeptical of Bitcoin, but it opened my eyes to results because every portfolio along that efficient frontier included some percentage of Bitcoin. And as you got more conservative, now that percentage was very small, it was less than 1%. Updated that same thing last week, right? Every portfolio along that efficient frontier. And I believe the largest Sharpe ratio of all those portfolios, or that optimized portfolio, had over a 5% allocation to Bitcoin. When I did that, it really opened my eyes. And so it does, you mentioned it earlier, it does enhance a portfolio and increases diversification. When we talk about that, and I know every situation is different based on the investor, what type of allocation do you think would be kind of a good earmark to Bitcoin for a typical portfolio?
In my book, The Truth About Crypto, I advocate a 1% allocation. The primary reason I do that is because, number one, this is new for most people, both advisors and their clients. A 1% isn't threatening. It's not scary. If it blows up and goes wrong, you're not going to hurt your client's financial future. No harm, no foul. But if it works and you have Bitcoin's outsized returns like we've had this year with 140% gain year to date, a 1% allocation can have a material improvement on the overall portfolio. So 1% is an easy, safe to get in the water kind of approach. Yale did a study. Their conclusion was 3.1% should be the optimal allocation. The CFA Institute did a study. They said 2.5% to 5% is the optimal allocation. So everybody who studies this is in pretty much agreement, low single digits.
Yep.
Nobody's talking about 20, 30, 40, 50% the way we do equities. But the only thing I can tell you is that the wrong answer is 0.
We can't have this conversation without talking about yields. What's in store for yields? And you talked about the inverted yield curve, which seems to be going on for, like you said, 20 some months. Yep. What is in store for yields in 2024? And do you believe the curve will normalize?
Yeah, that's a great question. I mean, I'm not a big interest rate anticipator. I've been doing this for 30 years. I always listen to people give you 20 reasons why it's going to go somewhere and it goes the other way. And based on new data, this is why we're revising our outlook. I love to look at the 10-year treasury. We came into last year at 388. Within a month, it was down to 330. Throughout the year, higher for longer, rates got all the way up over 5%. And lo and behold, we ended the year at 388. So it began the year where it started. Everybody predicted rates are going up. You need a duration. You need to be front part of the curve. Again, I think there's value across the whole curve. And I think that's very, very important that you don't try to anticipate the direction of rates. You can participate in both curve flattening, which I think we will see.
Yeah.
You asked me, what do I think about, normalizing the curve? It's been an unnormal past few years. A lot of the inversion was caused by what we saw during the pandemic, the flood of money, the fiscal deficit. We're not that inverted right now. It's been 21 months, typically 12 to 18 months out signals a recession. I gave you the reasons why I think we can orchestrate a soft landing. So as the Fed begins to cut rates, we're not only going to see short rates come down, but we'll also see long rates start to come down with that. As long as we're in a deflationary environment, we don't see a massive reacceleration of inflation. So that's good news for a fixed income investor because you get the benefit of declining rates. You get the benefit of discount dollar prices and then those assets returning to par.
Mm-hmm. Some fantastic total return options.
As far as risks, I think that the one risk I think investors should consider is whether they're being paid to take credit risk. Okay. So let me give you an example. First, let's define what credit risk is or how at least it's represented in the bond market. So a corporate bond, for example, will yield a certain amount. A portion of that yield is driven by the treasury market. And then there's an incremental yield above treasury yields that is called the credit spread. And that credit spread varies considerably over time. So what we have seen is that the corporate credit spreads in particular have tightened substantially, which means, obviously they've come down. And really they're approximately 91 basis points, as of close yesterday, Feb 20. So if you think about historically where that stands, that's in the second lowest decile of corporate credit spreads we've seen over the last 25 years. So what does that mean for investors' portfolios? Well, what we think it means is that it takes very little increase in that spread to really negate the positive incremental yield generated by corporate bonds. So if I use the Bloomberg Corporate Index as an example, that spread, as I mentioned, was approximately 91 basis points. The duration of the index is approximately 6.85. Duration is really a measure of interest rate sensitivity. So think if there's a 1% change in rates, there will be approximately a 6.85% change in price approximately. So the credit spread really, if it increases 14 basis points to 110 basis points, it will result in a price decline that overcomes that incremental yield. So when we think about managing bond portfolios, we're looking to ensure that we're being paid for the risk that we're taking, and we're looking to weigh the odds in our favor for our clients so that they generate sort of excess returns.
For example, in the world of stock valuation, what do? You look at the company, you look at the product, you look at the management, you look at the employees, you look at the competition, you look at the regulation, and you look at all of these metrics to come up with a comparable on other stocks in a similar industry to arrive at a multiple.
Yep.
Based on the number of shares and the multiple, you come up with a share price. Makes sense. This is how Warren Buffett got rich. Apply that to Bitcoin for a moment and look what happens. Bitcoin is not a company.
Right.
There is no product. It has no employees. There is no competition. All of those numbers are zeros. There's no profits. There's no revenues. You have to reach the answer that Jamie reaches. There's no intrinsic value. All the numbers are zeros. That's because you're using stock market valuation for crypto. You have to use a different type of methodology to come up with a realistic number. So the short answer is this. We could argue over whether or not Bitcoin has any value, but I'll tell you this, it certainly has a price. And right now that price is around $41,000 as we record this. So it's supply demand at the end of the day. And we are anticipating, due to the new ETFs that are expected, a massive increase in demand.
The next question I was going to ask was about, if not IRAs and 401ks, then where should, and you mentioned the Roth. Why, and again, you commented on, but why is a Roth so much better than a traditional IRA or 401k?
I'll give you a hint, 2 words, tax-free. I love tax-free. Everybody loves tax-free. If you ask somebody in retirement or heading there or almost there, would you like a taxable retirement or tax-free? I mean, tax-free is always better. It's one of my always rules.
Always.
I mean, but there's no question that the Roth is the single best retirement account to own. No question. The only question is, how much are you willing to pay to get it? That's all it comes down to. And that's where the rubber hits the road, because people say, yeah, I'd like to get it, but I don't want to pay for it. Well, it's not a choice. You're going to pay. It's not a matter of if, but when. And when should you do it? Right now, while taxes are historically low. And for those of you who don't realize it, because everybody complains about taxes, but the are the good old days. Now's the time to strike. In this book of mine on page 28, and I put this, I know you might not be able to see, but I give the history of tax rates from 1913 up to now, 2024, just as a comparison. And just to pull out a few years, the years people like me and probably many people watching this were born, the baby boomers. 1946 to 1964, just as a comparison to show you how good you have it now, the top federal tax rate for each one of those years exceeded 90. 90. Did you hear that? 90. 90. No, don't switch your dial. It's not static. 90%. Except for the last year, 1964, when they dropped the top federal tax rate all the way down to only 77%. Now, I was only 10 years old then, so I was watching the Beatles on Ed Sullivan at that point, but I heard from people who were around, they said the whole country did a happy dance, only 77% top rate, what a deal. Now, the top rate is not even half of that. This is the key to saving the most in taxes, and it's my second always rule. The reason I have all these always rules, you see people all the time on TV, not me, but they're wishy-washy. They can't make a statement without, weaseling. Well, could be, probably, maybe. It depends. You never know. I have certain always rules. My number one always rule, tax-free is always better, no question. Things that are non-negotiable, always true, you can take to the bank. The second one is the way to save the most money in taxes.
You just think about your smartphone, right? The level of customization you've just come to expect. Just you're surfing the web and you get served up recommendations based on, what you're looking at. I mean, I think, because the tech has progressed to the extent that it has, And there's a certain amount of expectation of customization that we've all just been sort of trained to expect. We're living in this cocoon of technology, as I often say. It's hard to imagine that people are going to be able to have that sort of experience in their personal lives, and then they go to their financial advisor and they don't feel any of that engagement from a customized perspective when it comes to their finances, you know? So I think the expectation is there, but that doesn't mean, you know, that every client has to have very granular personalizations. I think a lot of clients are still in a boat where a model works very well for them. The personalization may come around how you talk to them about the model and the amount of high touch engagement you have with them on it. So what constitutes personalization can differ depending on the client. And to make sure I answer to the, hey, what's driving this? Part of what's driving it, of course, is the experience people are having elsewhere, where again, customization is becoming so obligatory.
Most retired people don't get any more tax benefits for dependent children. Most retired people have paid off their mortgage, so there's no mortgage interest deduction. Most retired people are no longer contributing to a 401k, so there's no deduction there. And most of them now, with the rules for the last few years, are taking a standard deduction. So now you have a situation in retirement where you believed you'd be in a lower bracket, where your income is higher for RMDs and deductions are lower. What does that add up to? More income at, we don't even know what future rates will be. You know, I want to, back to your show, wealth adjusted for risk. I mean, I want to adjust your retirement savings for risk, and the tax risk may be the biggest single risk in your portfolio.
Thank you, everyone, for listening to this special episode of the Adjusted for Risk podcast. You can find the full episodes of these guests and all other episodes of on the Zephyr YouTube channel and iHeartRadio and Spotify. Thank you again, and I really look forward to another great year of insights and guests on Zephyr's Adjusted for Risk podcast. Thank you, and have a great rest of your week.